Yesterday, the US Federal Reserve left interest rates unchanged at 0.25% and announced it will not only continue to purchase $40 billion a month in mortgage-backed securities, but will replace Operation Twist with $45 billion of long-term Treasury securities a month. Joining me on the line to discuss this is Bernard Baumohl, Chief Global Economist at the Economic Outlook Group. Hello, Bernard. Bernard, what do you make of the Fed's decision and the additional purchasing of long-term Treasury securities?
What the Fed is doing is committing itself to keeping interest rates as low as possible and reassuring companies and individuals that the cost of borrowing will remain low. It's also trying to encourage investors to take more risky investments, that is, away from bonds, perhaps into equities or purchases of corporate security, corporate bonds, just to sort of revitalize, to stimulate the economy. So its primary goal, once again, is to speed up economic growth and bring down the unemployment rate, and it has gone so far as even to say that it is willing to keep these rates at such historically low levels up until the time when the jobless rate, approaches around 6.5%. So this is all a sign that the Fed is trying to do its best to provide some fuel to the U.S. economy.
What did you make of yesterday's FOMC projections for the US economy, and what do you forecast for the economy in the longer term?
Well, the Fed has slightly downgraded its forecast for growth in 2013, and that's one of the reasons why they continue to move aggressively and work to keep interest rates low. I think the key factor that will determine whether the Federal Reserve will succeed and whether the economy next year will do well is simply whether we'll be able to resolve this fiscal cliff issue that has really dominated all the discussion both in households and in corporate boardrooms in the United States. The U.S. economy is essentially on hold. It's in a holding pattern until we can better figure out what the economic outlook will be in 2013. And the outlook is tied to the resolution to the fiscal cliff. And until we get some clarity on that front, I don't think we're going to see consumers or businesses in the U.S. make any major commitments with respect to spending and investments. So we have this rather bizarre situation where the Federal Reserve has its foot hard on the monetary gas pedal to get the economy moving forward, while on the fiscal front, there's a great deal of concern about the paralysis in Washington and the likelihood that if there is no agreement, we might have the economy, or essentially Washington, put its foot on the brakes and cause the economy to slip into recession next year. And that is the dilemma that a lot of Americans now confront.
And what are your biggest concerns for the U.S. economy right now, and why?
The biggest concern I have for the U.S. economy right now is if there is no agreement on the fiscal cliff, and that Washington cannot come to terms in the first couple of days or weeks in January. What that does is it really sets in motion for a collapse of confidence in Washington and, of course, in the economy for 2013. It will be devastating, I think, to both consumers and to business leaders that the economy faces a downturn in 2013, and as a result, we're going to end up with this vicious cycle down for the economy. If there is no agreement on the fiscal cliff, which could lead ultimately to a recession, more unemployment, lots of job losses, and certainly this is not the path anyone wants to see the economy take. Nevertheless, there are people who believe that the odds are fairly high that we will have a recession if there is no agreement in Washington on a long-term budget.
Thanks for joining me, Bernard. Stay tuned to Dukascopy TV for more exclusive interviews and updates. For now, though, goodbye.